Okay, welcome. Apple Orchard model. We're gonna finish it up today. Let's get the link out to old Twitter. Part three here. This has been a crazy one actually. It's one of the first templates I've done years and years ago. I think I did it in 2016. So it's got a lot of stuff. Remember, so this is part of the industry-specific financial model bundle. It's all the way down here, Apple Orchard. I plan to finish upgrading this today, and I'll get the overview video of that tomorrow morning. I'm going to go through, there's going to be, let's just hope it goes smoothly today, I guess is all I could say. And remember, I got all kinds of smart accounting tools, industry specific models, templates, a lot of calculators, real estate underwriting tools for specific industries, mobile home park, self storage, mixed use, short term rentals, multifamily, um, a lot of just general joint venture waterfalls. I've done a ton of work in the SaaS space, a lot of advanced modeling here, best in practice, retention and churn logic. Um, and remember, I've got all kinds of categories here. You can buy by category. You can buy all the templates for $9.99. And I also walk you through any template that you purchase for 2 hours of paid time. So that's a thing I recently implemented. Okay, well, that's enough of all that. Let's get this up. And so here we go. I did a couple of changes on the annual detail while off stream. I just kind of updated the acres in use to match the change of um, here. So this is basically telling you how much the apple orchard, how big it is based on the amount of acres, and this is just a lookup schedule that a lot of the revenue is referenced off of. So I kind of updated this to hit basically showing the difference in 10, 20, 30, 40 acres. Um, and so that's all updated here. And again, you can update this. You can change this to however you want. All the light yellow cells you can change to show different scenarios. And then the lookup formulas will look up what you define as how many acres you have in use over time. And then this offset also applies to when the year that fruit starts bearing from the purchase of trees. So cool stuff here. A lot of cool stuff. Let's change this actually out to 2040. Um, you can also define the total acres bought here, and that should be the total you end up getting up to um, in most cases. Then staffing, I just kind of timed this up with the year of expansion here for when staff are added. But yeah, I was really happy with the way the assumptions I actually went into more detail and really thought about them earlier today. And you know, they're actually set up pretty good. I'm gonna keep the structure how they are or how it is, and it's all working anyway. So today, what we have to do is get these financial statements fully cleared and the executive summary, distributions, discounted cash flow analysis, all that's got to get done. So yesterday, I believe we ended up doing the income statement. We put in OpEx and we made the depreciation work dynamically, which it seems fine. It seemed, no issues there. Um, Same with the tax calculations. This looks like it'll be fine. Uh, let's let's see. Actually, did I zero? Oh, I zeroed them out. Let's put some numbers in here. Okay, perfect. So we got some taxes coming in. We have exit. And this is all working. You can apply some of the exit proceeds to any of the tree value or other equipment, and it'll pop in there if it's got any depreciation left. You'll see a net gain or loss. Okay, so that's fine. EBITDA. Let's look at the cash flow statement. So here, okay, we got revenue. OpEx is 15 and 25. Let's just make sure. Yep, that's good. Interest is 31. That's good. And taxes 58. Okay, so that's good. Now CapEx. So here's where we have, so this is going to be dynamic. So what we have to do is a sum ifs on this. This is going to be sum ifs, and I want to sum up the total cost basis of all this only if in this range we match the year. Okay, and then that should be able to be drug over. So that's building, that's any of the trees that are purchased. That is any other general equipment that's put on the CapEx schedule. So this should total, so 351.5, let's just make sure that equals the total. We got 631.5. Let me drag it over more. Yeah, so these are the expansions with new trees. 631.5. Okay, so that matches. So this is good. Now what we'll have to do is so on the balance sheet you can see how the accumulated depreciation is only going to be based on so we've got an offset. So see, this is the offset for the start month. For only the trees, they all will have, based on whatever's defined here, years until ready to bear. 2, so it means a full 2 years go by anytime trees are bought before they can be depreciated. Or if it was 3, you would see this, and this affects the whole model. And it also affects depreciation. So that's dynamic, and that seems to be working just fine. And, oh, well, we got some issues on the balance sheet, which I'm not surprised. We'll get into that in a second. Let's go back to the cash flow. So sale of business, let's just make sure the terminal value is working right. So final year EBITDA, yeah, we're doing an EBITDA multiple, so 2x final year. So let's see, income statement 28. Make sure that's, yeah, that's EBITDA. Okay, that's fine. And then, so 660. So just check that. Yep, okay, matched up there. Multiple is 2, so selling for 1.3 million, and that's going to be everything, and you get to find how much of that's going to go towards be applied to fixed assets. And it's really going to be a tax calc. If you don't show tax calcs, you would just put this at 100% and zero out these taxes, and you'll just see the cash flow before taxes, which is also fine, depending on what you're trying to see. And you obviously don't have to include terminal value either. You could hit no here. And in that case, all these would be zeroed out and it wouldn't matter. Okay, so that's there. And then you can see these two will add up to the exit value. And then this is just sale of buildings is separately calculated. But this looks fine. That looks like it's working. Debt principal. Ooh, what's going on here? So let's look at the debt tab. Start month is year 1. Why do we not have principal? Sum if debt schedule D. Oh, right. So Q is the year, not L. So that's one issue we had. So that's going to be fixed. Okay, that looks like it's working. So now sale of company stock. So this is where we got to go back into the annual detail and add these new cash flow items. So for fixed asset equipment beyond, well, actually, so what I can do here That will equal this CapEx, but we need to not count this because it's already, the tree CapEx is already here. And actually this could be negative. So 55, 52, let me make sure that makes sense. So 55 would be this and this. Okay, and then 52354. So 631.5 is what that should total up to. Those are there. Okay, so that looks like it's lining up just fine. We'll see, because there's going to be sanity checks at the end of this thing that make sure the annual details match up to the income statement, balance sheet, cash flow, executive summary, distributions. All that's going to be all matched up. But I like making sure it is while I'm doing it, just to avoid as many errors as I can. Uh, Annual sanitation services. All these are fine. So these items I'm actually going to block off because these are not OPEX items. These are, so you can see when I do OPEX, it's only these ones. Other cash flow items, taxes, exit proceeds. So we have taxes in there, exit proceeds is these two, and then I'll just keep the formatting. Bring this up. This is going to be cash flow. So here on cash flow, I want to do EBITDA minus this, minus this, minus this, minus this. So now I believe, well, let's just see what this turns out. And running cash flow is just going to be that. Okay. Break even year 12 on the equity required. To get the min equity required, we need to target row 67. So $1 million roughly, 1.1. You see that's going to go up to here. You can define the different sources of that cash, insiders versus outsiders, or you could just, if it's just one entity, you can just have everything go to overflow row 30, and that's fine, and just zero out all these other items and make sure these are all 100% for row 30. But if you have more complex financing and investor money, depending on what you're doing, then you might have to fill these out. Okay, so let's go back here. I just want to make sure this is going to make sense. Because the land cost is not depreciable, but it is obviously a cash flow item. It's not going to go on the income statement. Really, we're probably going to have to add a non-current asset slot for land, I believe. We also have some other things here. Yeah, and this is expected because this is a bit wonky how I'm trying to get it to fit the formatting I have. And my initial build of this, what was it, about 6 years ago or 5 years ago. It's a little different. So there's nowhere on the balance sheet here, well, except for it's on the assets. So the cash flow, let's see, do we have land purchase in here? No, we do not actually. So that's going to be part of CapEx. And it's only going to be for the first year because that's assumed to always happen in the first year. So where's that cost at? Land right here. Okay. Now, okay, so this 600,000 is the issue here. So that's where we definitely have to put this as a fixed asset that's not depreciating. But there's also some other stuff we have off here, obviously. So this is kind of the fun part. It's actually very frustrating, but when you figure it out, it's actually quite fun. Because it's like, you solve a puzzle. It's really great. Um, Hold on, just I'm trying to answer something about somebody's asking something about the mobile home park here. So what I have to do, well, is figure out essentially, and it's probably something to do with the cash flow. Like these CapEx expenditures. Oh, okay. So yeah, this is exactly it. So on the mining one, everything was assumed to happen in year one, but obviously on this one it's dynamic, so all this has got to be adjusted. So I'll do that 1 second. Make sure I don't have any comments here. Nope. Got a couple of viewers though. All right. So this guy's asking, your mobile home park looks great. It's hard to see on your waterfall. Um, let's see. So sometimes with these models, you have bottom up things, then you have top. Well, you have so one part of it is figuring out what the cash flows are by all these different assumptions. The other part is figuring out who's financing them and then how are the returns affected, or how are the returns split based on all kinds of different hurdles or return targets. So I'm just trying to send this over real quick. Uh, where is it? Cumulative distribution hurdles. Sorry about this. I believe when I update the balance sheet with this logic about um, there should be timing taken into account with these capex expenditures, we should be right on target. This is what happens when you got a one-man job, though. Sometimes you got to do this, and that you don't want to lose the business. So let me paste this over here. Okay, so that work shouldn't be too hard to just plug in cash flow to that. Oh wait, or shoot. It actually might be the preferred return or preferred equity version 2 that would fit. Sorry guys, we're getting on. We're gonna go here in a second. Just looking, I gotta do some customer service right now. Stand by. Stand by. Hey, if you have any questions, feel free to say something. If you have questions or comments or whatever, I'll answer it or talk to you. Just trying to get this guy a template real quick. Uh, let's see, where is this? Preferred equity version 2. And then we'll update this balance sheet. We're stuck on the fixed assets. We got to add in the land value, and then we also have to make the balance of each one different depending on the purchase month or purchase year. But it shouldn't be a big deal. Where is this? Ah, here it is. Okay. And I can do any custom work at 165 an hour, if you guys were wondering. Okay. All right. Let's get back into this. The wonders of a one-man crew. Okay, so fixed assets. So these have to be dynamic. I can't just reference the CapEx. So what I have to do is go, um, let's see, actually, so how did I structure this to go forward? Right, it can't be. So if this equals, let's see, how do we do this? We got a little bit of a tricky logic situation here. So I want to pull the cost basis if we're past or equal to the expenditure year. However, if it's past the end of the forecast period, whatever that might be defined, it needs to be 0. So how do we do this? Let's see. So let's just try and do it here. If the year is greater than or equal to the purchase year, then go here. Otherwise 0. And we have to lock the columns. C5 is greater than or equal to that. Okay, let's try this at first. Now, we also have to do if this is greater than the end year, then 0. And let's make sure terminal value D3, actually, let's use that instead. Let's format it as a date. Now, if we drag this down and over, we should balance and it should work. So let's see. So yes, that looks good. Now we should only be off by 600,000 land value. Perfect. Perfect. Oh, and then we have something on the exit year, which we'll figure out. But, okay, this is good. This is, the balance sheet's like the ultimate sanity check between all the different numbers and making sure you've classified things as the correct, you know, cash or asset or fixed asset or whatever. So this is going to be land. Now land is going to be assumed to be in the first year only. That's when you're buying the land right off the bat. You can't run anything if you don't own the land, or if you're not buying land. Let's see, cost assumptions E12. You could zero out your land cost. Just zero this out and just put your rent in as a annual cost here in one of these extra slots. But if you are buying land, it will be in the first year old. It'll always happen in year 1. So that we can put in here, add this, and then this will always, let's see, do we want to zero out this as well? Yeah. So this equals, as long as we're not greater than the end month, otherwise just give me the land value here. Perfect. Okay, and update this as well. Now we are getting close, so zeros here, that's good. We know we're off on the exit, so we're up by 815,000. So what else could we possibly be happening in the end period that's not being accounted for? Let's look here. 815, what could that be? Let's also look on this. And our assets are lower. Retained earnings. That looks fine. Let's see if it has anything to do with this number. Let me put this to 100%. Nope. Which is good that it's not that. So we continue on with our puzzle here. And figure out, so where's this 815,000 variance? Do we have all the accumulated? Oh, this looks like it's a little low. But, well, I guess, so on the exit, we are assuming these all go to 0, all of the non-current assets. we have to assume this 600,000, something happens to it. It can't just, it'll be a loss if it goes straight to zero without any depreciation. So we have to either assign some of the exit proceeds to account for this, or just assume it sells for the cost. And that's part of cash flow. So we might have to add that in here. Let's see, land cost, and we're going to put in on this row expected. Well, actually, let's put it down here under exit proceeds. And we'll say expected land value at exit if applicable. Now, if you're not including exit, it'll be 0. If you are, it'll be whatever you put into here. And shoot, actually, that's going to get complicated because then if you have a gain, that gain is going to have to flow into taxable capital gains. And it's just getting too complicated for the scope of the model. So I think we just say we're just including the 600,000 in at exit. So undo, undo, undo. Exit proceeds, just also say cash flow, sale of depreciable assets and land. And we just say if this equals terminal value, and just add in the value of the land as well. Okay. So that's just going to increase cash. We want to put that onto our annual detail. Oh wait, it already is on there. 2171. Okay, so that's there, that's there. Balance sheet, it'll be on the cash, and then it'll be coming out of here. Okay, perfect. So this 215,600 is what I thought we were going to be out. So this last piece we have to think about. And actually, let me make sure if this is no. If we don't include terminal value, let's see. Okay, yeah, so if that's no, then this needs to be 0. So if this equals no, then 0, otherwise pull that. And then, oh wait, let's end this. And I believe that should be fine. And then let's put this, so, okay, so that's, oh. All right, so this balances when we don't include exit, so that's a good sign. So we know it's something to do with the exit. So when I put this back to yes, we're up by 215. So what's going on at exit for 215,000? 215, 215, what could that be? So depreciation. $215,600 even, no decimals. 215,600. See, is anything to do with this? 215. Because I could see it being something to do with this CapEx schedule. Let's put this at 100, see if there's any effect. Nope. So this is one way you can try to figure out where a balance is, to start changing one thing at a time and seeing if it affects the variance. Let's change that, see if there's any issue. Still the same. Let's see, so this gets paid off here. This all happens. 215. So within these three statements, there's just something happening here at exit. What could it be? What else can we adjust here to see if there's something? Okay, nothing there. Let's do taxes. Maybe it's something with the taxes. Nope. Wow, nothing with the taxes. I thought that for sure might be 215.6. What is that? Is it? It's not any of that. Terminal value. Um, let's zero out that. I don't think that's gonna do anything. Nope. Well, we can start zeroing out some other stuff. Let's see if this does anything. Yes. Okay. So it has something to do with CapEx, and I knew it had to. So it's something going on here. What's it out by? What does it say? 99,165. Let's say we put this back to 10. 98. Okay, so we're gonna have to really dive into this CapEx schedule and see what we are doing here. So this is saying of the terminal value 396 and watch. I bet if we put this to 100. Now it's still an error there though. Say net gain is 396. If we go to the income statement, that equals terminal D3. J3 to J18 is less than 0 to 0. There's sum of CapEx J3 to J18. So it's taking this. If we put this down to 10, now it's a $297,000 variance. Hmm. Hmm. So that means it's got to be something to do with possibly the depreciation, maybe? Let's look and see what's our total depreciation here. It should be the total. 777, 775. This is 876. Okay, accumulated depreciation. What do we got here? This is saying it's okay. So here, what's the difference between this and all of the depreciation that's happened here? 98,725. That's not that number. Let's see. So this is saying it's fully depreciated. Let's see. C8 total cost basis divided by useful life times min of D8 and N. Okay, so this calculation might not work for how we are, because this is based on it working if the first year is always the purchase year, I believe. Because what this is saying is take the yearly depreciation times what's lower, the useful life or the years of operation, which makes sense actually, because that's saying, well, if you're operating for 20 years and the useful life is 10, well, then you're going to fully depreciate all of this. All right, let's go here to the income statement. So obviously there's an issue with this. So let's just go. First one's 50. That makes sense. 50. Second one is should be 70. That's 70. Next one is 70. 70. And then we got three 140s. 140. Ooh, here. Okay. I see, I see, I see. Yes. Okay, so here's the exact problem. This formula for cumulative depreciation works only if these all start in the same period, which they don't. So we need to put another column here that says years of service, and that's going to equal, let's see, how is that going to, that'd be the year of expenditure. Put this up one. Equals the year of expenditure, actually, the min of either the year of the end of depreciation or, so you want to pick the lower between when depreciation ends or the end year of this. So there's that, and then we subtract that from year of expenditure. Now what happened with this? Oh wait, terminal value's got to be locked. Okay. So, and then I think we got to add one to this. Hold on. Min of between this and that minus expenditure. Obviously, we don't have a negative, so we're going to do a maximum of this or 0. So that's fine. So this is 16 years, and that's saying it's from 2024 to 2040. So 24, 25, 26, 27, 28, 29, 30, 31, 32, 33. That should be 17. So, okay, we got to add 1 to this. So max, so min of here this or that minus this plus 1. And that is the basis. Now, hold on. We can't have the useful life be more than 10. So what are we doing here? I knew when I first started this model, I knew for sure this CapEx schedule and the depreciation was going to be the hardest thing with these offsets and all that stuff. Because remember, depreciation can't start until 2 years after you buy the trees. So for the building, it's fine. For these, I believe it's fine, but for these trees, I believe we can't go month of expenditure. We have to go month of depreciation starting. And it's from that time against either the end of depreciation or the end of the model. So 10, 10, 10. So that's good. It'd never be over 10. Let's see if you did 11 here, it'd be 11 or 15, 25. So it was 25 is still 15 because our end year is 2040. So it can never be over 15. Okay. So see 9, 4. So now these are fine. Let's check this. This is 25. Only get 20. So now the accumulated depreciation is times by this. Multiplied by that. Oh wait, by the, what did I do here? Min of D3 and Q. Right. Instead of D3 and N. And this is min of between this and here. Now watch, these are going to change. See, there's a change there. And what we want to do, and then this is also going to be here. Some of these are a little bit different. Okay, balance. Holy cow, it's balanced. Whoa, that's cool. Oh my goodness. All right, let's check if we don't include terminal value. Still balanced. All right, that's great. Uh, let's see. So this works. Let's say we go less time out to 2030. Still balanced. All right, I think we cracked it. Oh, thank goodness. So yeah, it was just an issue with it was using this total instead of the actual total, which is correct because again, this model is based on different month of expenditure. The other model that I imported from was based on everything having to happen in year 1. So different rules means different logic. Well, that's very satisfying, and that's where the fun of accounting comes in, I guess. When you crack the puzzle with the balance sheet, it's great. Really great. Okay, let's go back here. Let's make sure. What if we put 100% there? We're still fine. Let's go 60. And then these. So this is basically saying the available amount you're applying to this is less than the book value after depreciation is accounted for. So you have a loss. Now, let's see if we put in 5-year life for all these. You still got a couple left. Still a loss. Barely. Let's put a multiple on EBITDA of like 8. That's probably more realistic. Okay, so now you've got some gains there. You could probably say 30% is going to your fixed assets. All right. Balance sheet's all good. Taxes look good. Okay. Excellent. So let's put our financing back in, make sure that works. Now that should change the total equity required for the project. So hold on. We have the debt in here, but do we have it on the annual detail? Debt funding. I don't, we might not. So that needs to be in here, obviously. So debt funding, debt proceeds, and then that will just simply offset the initial costs that you got going on here. And remember, you do have some OPEX happening even during the first year or two because you've bought the trees, you're operating, but you don't have yield for whatever you put in here as the years until it's ready to bear. So, all right, debt proceeds. We do if this equals this. Oh, it's automatically going to be in your 0, so that's fine. Then this, otherwise 0. Okay, and add that into that. Okay, now if I change this, perfect. So yeah, because that should affect the equity required. Balance sheet's looking good. Although, normally the balance sheet should solve for 0. So we might be missing something. Let's look here. Right, because we're taking this minimum, which is, what is it, 1938? Hold on. Why is this 250? Oh, 250,000. So the minimum, you got some burn happening. You need 1688 to survive the whole thing, it looks like, which is this number. So we are missing. Let's see, do we have debt proceeds coming in here? No, oh wait, yes we do. So now we got to match the cash flow statement with this annual detailed cash flow and see what is not matching. So it shouldn't be that hard actually. It's just, so this first year is this minus the equity. Yep, so it's off. Year 2, 81 minus this. All right, so what's this 17,986 I see every time? It's good that it's a single number. It just means we're missing 17 interest in principal. It looks like, yep. So I must have removed that when I took out these. So we need to put back debt service. Debt service is just going to equal the debt schedule payments. B, if the year matches the year. And that's another cash out. And that's what we're out by, I believe, yes. So minus this. Perfect. Okay, drag this on over. This is saying we actually have an expenditure in year 15, but we're ending the model early, so obviously that's not logically copacetic. Let's just extend this out. Like when you're going through and updating this, you obviously wouldn't say, okay, I'm going to end the model in 10 years, but I'm actually going to be buying trees out for, 20 or past 10 years. Right. So that's good. Balance sheet's still good. We don't have our zero solve yet. We're getting closer. Let's go back here to annual detail. So it looks like it might be year one. Something in year one I'm not accounting for. Because this minus stock 375. So what's 375? Even 375,000. 375. Well, this is almost 375. Let's see if that has any effect on the number. No, it does not. So this has the negative amount is too high, is what's happening here. Is this something with this? It's 335. Land cost, are we subtracting that out? Yep. And cash flow, our capex is 740 negative. Does that match? Basically, that should be this, uh, land cost. 1.39. And here we're saying this is minus cash flow. D17. So this capex item against the tree capex. Okay, I think I see what's happening here. And we have double counted the cost on the annual detail. So let's go back to our capex. In year one, we have 50, 70, and 20. So 140. What's this doing? So much? minus 34. Well, why are we taking out land cost in this? Oh wait, we're adding it in. Hold on, let's just remove it completely. So it's 140. Now we have to say, well, we're also taking out cash for the land, so minus this. So 740. So land, and then the fixed assets are 740, which I believe I just said. However, we are then resubtracting out. Oh, this is the capex for the trees. Let's just do the same formula for this. So fixed asset equipment is just going to be sum ifs, capex, cost basis. Well, not the building, because we know that's already in. Well, let me look here. Is it in here anywhere? Yeah, the building's here. Trees are in there. So really, this actually just needs to be this. If our purchase year equals the year here. Let's try this. So here's a situation where you actually have a balance in the balance sheet, but our annual detail doesn't balance that, and there's no check for that except for seeing if the balance sheet solves for 0, which it should. Okay, now we're out 275. So if we go here, 740. Hey, we had 3 people at once. Nice. All right. Well, I'm glad you guys are, finding this somewhat entertaining here. I try to figure out this puzzle. Okay, what did I say? We're out 275. So cash flow 593. In here, I've got basically, if you take out this, 868. The total from all capex here is 740. I think, so that's doing C3 to C18. So that's doing all of this. So you've got the building, you've got the trees, you've got all of this, and then you're also adding in the land. So 740, let's just manually do it out. So it should be just taking this one, and this one, and then 600,000. So that's 740, so this number makes sense to me. Here, I've got trees, building, this, and this, 740. Okay, and then we've got OPEX of 85,650. Here I have OPEX of 360,000. Oh, startup costs, man. Oh my goodness. This is where things get hard when you have new models you're working with, and I'm not used to this one because it's so different. I built this a long ago. All right, so let's get the startup costs in there. Startup costs, and that's always going to be in the first year as well. It's this total. So we want to minus that. All right. I believe we're balanced now. Let's look at the balance sheet. Do we get to solve for zero? Yes. So this zero, that means we're actually, these numbers match what's going on in the annual detail, and the proper amount of cash requirement is being populated here. Thank goodness. Okay. I believe we're done with the model. Well, no. We got to do executive summary. So let's do this. There's other OPEX is just going to be that. Startup costs will be separate. We'll give this an if error so it looks nice and clean. Same with this one. Man, it feels good to, it really does feel good to get that completed correctly, but it took a bit. And that's literally the essence of doing three-statement modeling, especially when you're doing integrations like this and you don't know, you're not used to where things are. Okay, so that's good. Oh, we're doing salaries and wages separately. So this is general OPEX, and then here's your wages. Okay. Let's drag this over, and this is also going to have to balance out with everything. All right, so taxes, we're just going to go right to the cash flow statement. CapEx, right here. Debt service, we can use this. And any negative I want to pull through as a negative, actually. Format this all the same. Okay, so this, what happened there? Is there no taxes? Oh, that's right. Let's put 10 and 20, or put some numbers in there just to make sure it's working. Okay. Okay. What happened here? Why is the taxable income so different? Oh, OPEX changed a lot. Okay, good. That makes sense. Where was I? Executive summary. Okay, so that's good. CapEx is good. Debt service. Startup cost is in there. Proceeds from sale. Is that right? 18 and 19. That's good. Loan proceeds, that's fine. Okay. I believe we're looking good here. Let's drag this across. So 15,452. Nope, 8,058,000. So we're definitely not accurate there. Something's wrong. Oh, obviously this is probably wrong because we changed the signs. So EBITDA, plus that, and make this a negative. Okay. 8,058,729. 8,058,729. And the balance sheet cash is 9250, but if we take out the equity, that should match 858, 729. Okay, looking good so far. And we'll do sanity checks for all this. Distributions is going to be based on the annual detailed final cash flow, so row 69. Here, and we want any cash flow years that are greater than 0. And what's the year count? 2 or 3. And I'm doing this, okay, so 2. Okay, and then anything less than 0 here. Okay, that makes sense. So now we have remaining equity to use, which is going to be the total equity contributed, and then let's say plus debt minus startup costs, minus this. Actually, I guess technically you could have taxes in year 1. Anything else? Hold on a second. I'm confusing myself now. Remaining equity to use. Normally I have a year 0, but here I do not. So let me pull up the mining model real quick, see what we did there. Where is it? Okay, let's see how I did this on the distributions. So I just did equity and then I added annual detail E66. Oh, I had a year 0 for this though. And I just did it against the total cash flow for year 0. Okay, so I guess for this it makes sense to say year 0 is technically just going to be the total equity because nothing else is happening in year 0. And okay, so that's correct. And then this is just going to be that, and that's the same. So run at deficit, and then we have start making some positive cash flows. Now, this, let's make sure these are in the right cap table 31. Okay, so that's right. This kind of cash flow, investor cash flow, net present value. Let's give these a decimal here for the internal rate of return. All right. And then we want to check these. So sum of all of this should equal the annual detailed cash flow. Perfect. Okay. So that's the check. Okay, that's good. Executive summary. This looks 12.55755. C9 to AZ. Yep, that's the right length. So this all looks good. Make sure this total 9250. Okay. That's right. So that's kind of the return summary. This is not relevant. Debt service coverage is relevant. Although we're running this as a negative, so we need to offset that. There we go. Okay. Well, what a model, man. What a model. We're going to do some checks here. Let's do some sanity checks and start changing some assumptions and making sure everything still balances. So balance sheet annual. It's this one. It should always go to 0. It does. Annual detail check against balance sheet. So this we're saying is the final balance minus the final cash balance here. And then that will be equal to equity required. Okay. Executive summary. Oh, we didn't check this one, but what we can do, it'll just be this last one minus that. Okay, looking good. Distributions. Oh, I didn't even look at the distributions. It looks like it's matched up though. Let me go to the cap table just to see it. Yeah, that looks right. Coming over, so 55 and 6, that's the right numbers. Okay, good. So this is all fine. Perfect. And then individual, so that's fine. Going over to BK. Cap table. Okay, double check this. Distributions to AZ, is that the right? Yep, okay. Okay. All right, we're done with the model. Let's check it out though. So we go end year. Let's just change this to something. Let's go to the end, very last year. Oh, we have some value errors. So what's going on here? Debt schedule possibly. December 2050. What's the value error? Sum if debt schedule B, if Q equals that. What's the problem? Summing up B, if Q, wait, so this goes to 50, which is fine. Why is there an error here? Uh, Unhide. I don't understand. Why is there an error there and not here is the question. 2070, or yeah, 2070 December. Is that more than 30 times? Wait, no, 2070. Okay, well, let's just put, because that's obviously not even relevant. It's so far down there. You'll never have that schedule that far. So let's do if error, get this, and it's working for all the rest of these, so that's fine. You're not going to have debt that's more than 30-year term probably. If you do, I mean, you could go up to what is this, 40, 50? Yeah, it still works. So that's fine. Okay, let's come back here and see. Okay, so this is working now. Uh, balance sheet. Okay, so what happened here? Balance sheet. 1.6 million off. Why is that? Uh, well, these are fully depreciated, so this could be 100%, but I don't think. Oh, wait, that is it. Okay, right. So if you're fully depreciated on the CapEx by the end of your forecasting period, if it's really long, like 50 years, and you have all these fully depreciated, you need to put terminal value at 100%. Otherwise, like if I put 95% here, it's trying to apply 267, 602 to the CapEx, and there's nothing to apply it to because it's fully depreciated with this logic. So you can see here the balance sheet's now off 267, 602, which is just this amount being applied to CapEx. So you can just put 100% there in that case. Okay, so that's fine. Let's go back to 2040. Let's check if we do no on the multiple. Okay, we have an error there. What's the error? Balance sheet's fine. Cash flow statement. So let's look. So what is this uh, against the balance sheet? So we're saying we've got two. Oh, perfect. Debt service. So here, if the year is greater than the end year, then 0. Because that's saying we've got debt service past the end period, which obviously is not the case, but we're just ending the forecast earlier and we're not including terminal value. Okay, so now it's back to 0. Check. That's good. So no. If we put yes, it's fine. Let's see, we've already checked all this other stuff. This is just changing numbers around, but the logic all works. So I think we are good to go on this. This is a really cool simulation, and it'll get you thinking about all the economics of an apple orchard. It gives you the three-statement model. It gives you executive summary with a return summary, just high-level details of the operations, revenues, your costs, other cash flow items. Just kind of cash flow analysis here, net present value. Um, pretty good here, pretty good. This was a tough model to upgrade. I'll do the overview video probably tomorrow, probably hopefully under 10 minutes. That'll just go through all the tabs and all the logic again. Now that it's fully updated, let me check. Okay, we're good on that. And let me extend this out. Okay, no worries. And then that's fine. We'll put this back to 2040. All right, good stuff. I am off. If you guys remember, check out smarthelping.com. I do all kinds of industry-specific financial models. The one I've just did today is one of the earliest ones I've ever did, the Apple Orchard, but I've done all kinds of models like this. Also, I've done a lot of SaaS, a lot of real estate industry-specific stuff, accounting tools, trackers, inventory trackers, and then again, you can buy in category, or you can buy everything for $9.99. And again, I'm offering a service now. If you buy any template and you want to walk through, I'll spend 2 hours of paid time, obviously, and I can walk you through kind of how to fit the templates to your situation. All right, I will catch you later. I'm going to be on vacation, bike riding Thursday to Sunday, so obviously no streams or content there, but I'm happy to get this done for the week, and we'll see you guys on the live stream next Monday.